So we're now going to kick off. So the title of today is called Closing Your First and Further Investment Rounds. And I'm going to kick off with some introductions from our fantastic panelists. So can we start with Chris, please?
Sure. First of all, great to be here. I'm Chris Wheatcroft. I work for Ascension Ventures. Ascension is an early stage venture capital company specializing in SEIS and EIS investments. I do two things for Ascension. So I run the Ascension Life Fund, which is a health tech and life sciences fund, focusing on post-seed, pre-series A investments, so rounds kind of between kind of 500,000 and 3 million. And I also run the Ascension Syndicate, which is essentially a network of investors who invest alongside Ascension.
Thanks for joining us, Chris. And we've had you involved in some of our physical SuperNext series events around the UK. So thanks for joining us here virtually. I'm now going to hand over to Jo to give an introduction to herself and IQ Capital.
Thanks, absolutely great to be here. I'm Jo Slaughter-Newson. I'm a venture capital investor at IQ Capital. So we're an early stage deep tech fund, and that really means we invest in any sector of science or engineering where there's some genuine innovation, sort of typically IP rich. So we invest across kind of a range of early stage. So we make investments between sort of 500k up to 6 million initially with follow-on capacity. We're based in Cambridge here in the UK, but we invest across the UK and across Europe.
Jo, and I think you were our last speaker that joined us in our last physical event about a week before lockdown last year in Milton Keynes. So yeah, it's great.
The last day I was anywhere physically as well.
Yeah, absolutely. So Max, can you give us an introduction?
Sure. I'm Max. I'm in the deal team at Seedrs. We're an equity crowdfunding platform that invests or co-invests with rounds anywhere from 100k pre-seed all the way up to 15 mil Series B, Series C. Last year we closed about 254 million pounds of investment for 276 companies. So we're focused on working with companies with communities and facilitating an equity crowdfunding campaign.
Fantastic. Well, we've worked with Seedrs for a number of years, and at least 6 or 7 of Max's colleagues have joined us around the UK for the SuperConnect series. So we're delighted that Max is joining us here today. Let's go over to Eleanor.
Great to be here. Thanks, Kosta. Eleanor Boardman from DSW Ventures. So we're a stage VC based up in the Northwest. We invest between 250k up to 1 million in early stage businesses across most sectors. And I've been in my role for about 18 months now, working within the investment team.
And I know we've had your colleague join us in a few of our events, and it's great to be hosting you. And last but not least, Adam Beveridge from SFC Capital.
Hi guys, yeah, good to be back on the other side of it this time. I was a founder not so long ago myself, in a lot of the shoes of the founder's picture today. Took my company from idea all the way to kind of Series A, full-time team of 12, etc. So I've done the journey, and I'm very much on the other side of the lens now, working for SFC Capital. We're one of the largest kind of early stage investors in the UK. We're sector agnostic, so we invest in almost anything really, at SEIS and then follow on in EIS investments. We did around 100 deals last year. We're on course to do the same this year, excitingly. I kind of oversee the whole process from, going out and finding the startups to invest in, negotiating term sheets, doing the DD, then eventually supporting once they join the family and the portfolio. So that's me and that's SFC.
Yeah, it is great to have you. We worked with Holobox for about 3 years from the start of your journey. So it's great to have you on the other side supporting founders and having been on that, and you can relate to them and they can relate to you.
Very much so.
So yeah, so let's jump into our questions now. So the way we're going to break this down is, this is about closing your first or further investment round. So it's about selecting the right funding not just investments, but the other sources that are available, and the trade-offs with that, the preparation that you have to go through as a founder, the pitching, pitch decks, and so on, the negotiations, due diligence, and really the whole process, really. So I'm going to kick off with my first question, which is, in the opinion of our panelists, who is right for equity investment and who doesn't it suit? Does anybody want to take that first question to kick off?
Happy to, if that.
Yeah, absolutely, sure.
Yeah, super. So I would say, any business needs to be aware that equity is just one of many forms of raising financing, and it certainly isn't appropriate for every kind of business. And I think if you sort of go back to the drawing board, the best way to fund any business is to get revenue, to get customers to pay for what you're doing, to pay for the activities. It's kind of positive feedback. They want what you're doing, they need it, they pay you, you do it. And the only reason to kind of consider any other kind of investment is if you're not yet ready to go out to customers, you need to build a product, you need to scale, or you're looking to grow faster than you can just by organic growth. And then different funding options are available to you. Sometimes getting a debt investment is actually cheaper than getting an equity investment, but that's only available if you are at a sort of sufficient stage where you've got a business that's working, you've got steady profits, and you can take on that kind of investment. So equity is really where you have to do something you can't get customers to pay for yet, and it's at a risky stage. So there's a good chance what you're doing might not work. Maybe somebody's not done it before, and so you need a kind of investor that's going to come alongside you, taking part of that risk, part of that equity ownership in the business, and really partner with you going forward.
Absolutely, that's some great insights. Does anybody want to add anything to that?
Yeah, I mean, I think it also comes down to the type of business. So equity investment is typically more suited to scalable, high margin businesses that can justify the valuations that come with equity investment. So typically a services business or a consultancy business might not be quite as suited as, say, a technology business. And I think it also comes down to sort of the type of equity investment as well, if that is the route that you choose to go down. So, anything from friends and family putting some money in to an individual angel, a syndicate of angels, or an institution, they all come with their own pros and cons. So it's what's right for your business within equity investment as well.
Excellent. Thank you so much for those insights. And startups do pursue different avenues. There's grant funding out there, whether it's Innovate UK, debt finance, and at different stages of the journey, they consider whether to blend their fundraising round to support that. Sorry about the police car in the background. I just let it go past my house. In terms of that, with that in mind, sorry about that. With that in mind, do you like companies to have a blended approach to finance? Do you like them to only be going for equity investment, or do you mind there being grant funding in the round? Does anybody want to, Chris?
Sure. I mean, I guess from our perspective, it's good to take on non-dilutive capital. I guess the caveat that I would say with that is you can spend quite a long time trying to find those grants, and it can be a kind of distraction from your kind of core business. So I think absolutely look for any non-dilutive funding that you can get. I would say is a good thing, but just be aware that it can be a distraction. And also, it can come with strings that you should be aware of, that it might be for a specific thing that actually might not be your core business. I've seen specifically people taking Innovate UK money that was for a particular project, which was interesting for them, but also a kind of distraction from what they potentially should have been focusing on.
Yeah, that's a great insight, because there are certain tick boxes that come, or KPIs that grant providers want startups to hit, and that can take them away from their mission and what they're actually trying to do. So that's a very good insight. Did anybody else want to add to that question, or should we move on to the next one?
Maybe just to reiterate that, yeah, I've seen that as well, where there are grant funding calls that are in quite specific areas, and companies sort of twist and turn to make what they're doing sort of fit into that, and it means they end up doing something that's not core for their business, and is just a distraction. But yeah, otherwise, absolutely, good financial management should mean that the companies are looking at various different ways to finance the business, and yeah, a blended approach is great where appropriate. And obviously non-dilutive is great for everyone.
Absolutely. So now in terms of the preparation and pitching from a startup's perspective, when companies share their pitch decks with you, what are the key factors that make you want to follow up, whether that's in an email, an event? Is it traction? Is it revenue? What is it specific to you as an investor and the company that you represent?
I can dive in. For us, being really early stage, it comes down to two main things really, which is traction and team. Team being really important because, circumstances change, like the pandemic's proof of that, right? Products change, things change, and founders are the ones that are steering the ship through it all. So you need to be able to believe in them, that they can, react and be proactive to things. And traction is really important. So many common mistakes. I think people come with ideas for things but haven't quite validated things yet. And I think there's a lot of validation you can do in terms of user testing of things, even if you're an online product, doing that offline just to validate what you do. And the problem you're solving, your solution actually solves that problem, is really key. So I would say, definitely for us, traction and team are the two kind of main things you want to look for in an early stage investment.
Fantastic. Well, I want an answer from everybody. I think this is important for this question. Who's next? Sure.
I'm happy to jump in. I think that's a good point from Adam around traction. If you have validated the product, you do have traction. If you are in market, make that very clear. It tends to get investors' attention. It certainly gets our attention. We do work with a lot of sort of seed, pre-seed businesses that might not be in market yet. And I think, if that's the case, it's again, sort of reiterating Adam's point, demonstrate the opportunity, but also more importantly, highlight, why you and the team are best placed to execute on solving that problem.
Great. Thanks for that, Max. Chris, do you want to jump in?
Yeah, sure. So absolutely agree with Adam and Max. The only other thing that I would add is kind of an understanding of the core drivers of your business. So we'll expect to see a financial model, but I can tell you 100% guarantee that your financial model will be wrong. But what I want to see is the fact that what the drivers of your business are. Whether that be kind of customer acquisition cost versus lifetime value, or whether it be channel partners, how to scale your business. But I would say that is an absolutely key thing that we look for on top of kind of the team and traction. The other thing I would say is kind of sustainable competitive advantage. Why do you win versus the competition? And that will probably be a kind of blend of all of those. Of all of the things above. And sorry, one last thing I was just going to say is, in terms of the traction, don't wait until slide 53 to put in your traction. Show it early on, because you want to get an investor's attention early and say, okay, these guys are in market. They've got lots of customers. They are growing extremely well. I think it's important to get that early, just to kind of generate that excitement as you're kind of telling the story.
Absolutely, that's some great insight. And Eleanor?
Yeah, I absolutely agree with everything that's already been said. For us, it's traction, team, making the USPs really clear, knowing your competition. Competitor matrix is really useful with that. I think also just basics, whether it meets our investment criteria. So things like stage, again, traction, round size, that kind of thing. Just make them really clear and state them up front.
I think that's very important. And over the years, I've worked with Adam on whether startups should take a scattergun approach and just approach everybody, or whether they should be targeted. And targeted is always the best for both sides, because I think for yourselves as investors, I think you can tell a mile off who's copying and pasting the same thing and has not really thought about your requirements or what you look for. So to anyone that's listening, I would encourage a targeted approach to make your life easier and their life easier as well. So we've talked about those types of factors now. What are the common mistakes that you see when you see pitch decks or even pitches? What puts you off? What puts you off progressing any further, where you go, no, I'm moving on?
I get anything that says like puts me off. I don't know if the other guys agree with this. Quite often, someone will do a pitch, and the first question from me or my team is, "Can you explain exactly what you do?" Because I think so many founders, I think, work in silos quite often. You know, they get used to the day-to-day jargon. You know, they're living and breathing their businesses, and they can take you through this whirlwind of a pitch and not be really clear on what they do, why they do it, and what they solve. And like, I see that with so many things, you know, complex products and things, and they forget to really nail their value proposition, exactly what they do. And I think that's it. You know, you shouldn't be starting the Q&A bit of your pitch with revisiting exactly what you do. You want to know it, you want to nail it, you want to really use the Q&A time to, you know, give the investor a chance to ask the burning question that's on their mind, kind of thing, not revisiting that. So that's a bit of a red flag. I hope the other guys agree.
Yeah, definitely.
Yeah, that's a common mistake I see.
Yeah, I'd agree with that. And also, you know, what exactly do you do? And also, who cares? You know, who needs this? You know, if somebody's gone into intricate detail about some, you know, technology, for example, you know, what is it really you're doing, and who cares? But I think something else for me is a real red flag is where people say, well, we have no competition. Isn't that great? There's absolutely no competition for what we're doing, which means there is no market for what you're doing. And inevitably there will be competition because there'll be kind of an incumbent, even if it's, you know, people are doing this on Excel, they're doing it manually. You know, there will be something people are doing that is the competition for what you're doing, what you're displacing. And sometimes if there is a little bit more direct competition, actually that's a good thing, because it shows that there is a market, there's a need, and then you can explain what you're doing better. If you say there's no competition, that's either really worrying or means that you've just not done your homework.
I literally spoke to a founder yesterday, said the exact same. Investors like a benchmark or a precedent, right? They want to see something likely that's happened, and then they're more confident of knowing, you know, later investment rounds, exits, things like that. Whereas if it's completely new, like you said, sometimes it's like, well, it's more of a risk in that way. So yeah, I totally see what you're saying.
Any other insights to that, Chris?
Yeah, I mean, sorry. First of all, just to say, completely agree with Joe on that. That it kind of either shows kind of naivety or arrogance to say that there's no competition, even if it happens to be kind of adjacent. The one that I was going to say is kind of the top-down modeling. You know, when we're doing market sizing, or when people say, "Oh, all we need to do is achieve 5% of this 50 billion market and we'll be a massive business." That's kind of fine as long as you can justify it, but I'm much more interested in a bottom-up approach that says, you know, we need to get these customers, and the way that we're going to get these customers is by doing X, Y, and Z, or we're going to go via channel partners who will give us access to this number of customers. I like to see it built from the bottom up, and it may be a personal thing, but I would say that yeah, top down is again a little bit lazy.
Just in the interest of time, we'll move on to our next question. So valuation. I know some of you feel very strongly about this. What's your advice on this? Your perspective? You know, how should companies value themselves? Is there a particular methodology? Are they? I think Adam said to me that some companies are overvaluing themselves at the moment. What's everybody's take on this?
Just jump in to build on what Chris said around, I guess, issues in pitches and pitch decks, and particularly around valuation. Quite often we see companies take a sort of top-down approach in terms of we're raising 500K at a 4 million pre-money valuation, and then they haven't really given any rationale why. So I think it's better to take a bottom-up approach in terms of you want to build that story and be able to justify why you're putting that price tag on your business. And I think kind of doing that preemptively is really jumping the gun. I think valuation is something that develops over a conversation, and it's really something you need to justify and stand behind, whether that's industry comparables or forward revenues, pointing at the kind of market size of the team. It's not a case of picking a number out of the air and sort of sticking to your guns on that. It's definitely more of an art than a science, particularly at the early stage. But that's one thing I see a lot is kind of companies just picking a valuation out of the air without any underlying justification.
I'm happy to give some advice on it. Like at our stage being really early, a lot of founders come to us first round of funding, sometimes the first investors they've even spoken to, right? And they say, well, I don't know how to value myself, which is often a case. And I think a bit of advice with that is, coming back to what we said about scattergun approach or targeting investors, if you do the time to create a list of investors and properly do your own due diligence into them, look at their portfolio, look at what they've invested in their portfolio. You can either reach out to founders of these companies directly, see what they're investing in, go on Crunchbase, GoHurst, any of these guys, or reverse engineer it, right? A lot of funds say, we typically invest 500K and we like 20%, you can reverse engineer that. Say, okay, they're looking at the ballpark of around 2.5 mil kind of valuation. For us, we look at SCIS, so that's typically 150. We want to take between sort of 10 to 25%. So that's a good way of trying to work it out, and then at least you've got some logic to, you're in the ballpark of those companies. That would be my advice if you're very early stage in terms of not sure where to go with your valuation, because you can get to DCF modeling all that stuff much later. It's just not going to wait to it when you're really early.
You sound like somebody that's heard the hard way.
Yeah.
Any other insights?
I agree with Adam. I think it's also important. It's important that the founders, are realistic and ask around and do their research, but also bear in mind if you're looking at comparable transactions, for example, for listed companies, there is a difference in scale there. So just bear that in mind as well.
Right. We might have covered this in the pitch deck side and the preparation side. But in terms of people actually pitching to you, obviously with COVID, it's really hard to get these face-to-face meetings. You're probably doing a lot of, Zoom calls, etc., or doing some of these virtual events. But what advice can you give to founders when they're delivering their pitch to you, either in a call, in an event, or even via email? Chris?
So I guess the first thing I would say is just make sure that there's a difference between a kind of investor overview presentation that you're sending out to an investor and a pitch that you're giving at an event. And I'm not going to name any names, but there was at least one earlier on that had far too much text on the slides. So I think make sure that it's super punchy. If people are reading text on slides, they're probably not listening to you. So just get the kind of key information across. You're not going to sell the business and get them to invest probably on one call, certainly not with a venture investor. So make sure you're just getting across the key information, getting them excited, and then you can start that conversation. But kind of less is more when it comes to presentations.
Take one other insight and then move on to the next questions, as we've only got a few minutes left, 5 minutes left. So who wants to add to that? No? Okay.
Sorry, I just add to what Chris said. It's just important to tailor it to the context, whether it's over email, a pitch, or on a call with an investor. So if you're on a call, usually the investor will have already seen your deck. So just be prepared to dive into more detail than what's already on the deck, and be prepared for us to sort of stop you at slide 2 and discuss an issue for a bit longer than you'd like to at that point. Just be flexible.
Indeed. And then the final area, negotiation and due diligence. How should founders approach this? Should they be having vested equity structures in place with a 4-year vest and a 1-year cliff? Is there certain company structures that put you off at this stage? Yeah, what's everybody's insights? I know, Eleanor, for example, you wanted to add about option pools for funding, for future hiring.
Yeah, so option pools are obviously really important. You know, it's incentivizing future hires long term. So we'd like to see them vest over time with also some on exit as well to make sure that key management are around and incentivized for exit. And the same applies to founder shares as well, I think. And that's also a company issue as well as an investor issue. So, you know, if you're a co-founder and your co-founder decides to leave, you should agree up front, you know, if they hang on to their equity, then you're putting in all the hard work and they're getting a free ride. So it's really important to, you know, apply it for your own benefit as well to the founder shares.
And I suppose,
So I was just going to add really quickly on this sort of stuff. If anything like this has already happened to you, because it happened to me at Hollobox, right? With, you know, with founders leaving and stuff, like, don't try and hide it. You know, it'll come out in DD. Be upfront. Say, look, you know, I had a founder leave. They're still on the cap table. Anything like that. Just be upfront. It's better to address these things earlier than hide them and come around later. So that's just a bit of advice I would say with this sort of stuff.
I'd also say, like, speak to your mentor, speak to your advisory board. I mean, I was on Adam's advisory board at the time when his co-founder left, and I remember you called me up and I talked you through it at the time. So it's really important to be open and transparent with everyone. Okay, and I think, Joe, you wanted to add about exit preferences and being clear about that.
I guess sort of exit preferences in the deal structure is kind of quite a niche thing to maybe dive into sort of micro scale, but I guess just maybe kind of in the context of this more general discussion, actually just thinking about the exit, planning for the exit, in terms of understanding that if you are taking equity investment, they will need to get an exit from that. That means, you know, maybe you'll have to sell the business or IPO, go public, that sort of thing, and make sure that you're aligned on those. And then, yeah, just I guess the specific, I don't know if anyone wants to follow up about sort of specific kind of exit preferences that we're seeing. I guess some founders find it really difficult to accept a kind of like a 1x kind of participating or non-participating exit preference, but maybe sort of just a little bit of advice that actually getting in a more benign preference structure early can help you kind of keep that for the long term. Whereas if you kind of get to sort of Series B, Series C, and new investors are coming in and there's no preference, that it might, something, you know, quite aggressive might be sort of forced on you at that point.
Thank you for that, Joe. Just so everybody knows, there is a 10-minute section for the exhibitions. We'll just carry on for a few minutes just to finish off these questions. Max and Chris, what are your insights on this due diligence and negotiation part?
Well, so I would just quickly say that make sure that you've got your documents together. It's a very kind of telling sign for an investor if you know you've had a good call with the entrepreneur, and then you know, right, okay, we want to start our due diligence. If someone can then give you access to their data room, and it's full and kind of comprehensive, that's a good sign. If it takes weeks and months to get the information through, that kind of makes our lives more difficult, and because we've got lots of things that we're looking at, it will probably push you down the list of priorities. And you know, you might want to have two different data rooms, one being a kind of pre-NDA one and one being a post-NDA one. So it's kind of like, okay, I'm happy to share this information with anyone, and then if someone gets to a kind of later stage due diligence, you can kind of you know, give them access to the full information afterwards.
Absolutely. And Matt?
Yeah, I just might add on Chris coming at this from an accounting background. I think it's very important to have your accounts in order. You know, if someone asks a question about the debts or what's your cash balance, and then it takes you weeks to come back on that, it's a bit of a red flag if you're not managing that and have that information to hand. And then sort of just building on I guess, structure, particularly at the sort of pre-seed, seed level, I really just recommend keep your structure as simple as possible. If you're a UK business, just have a UK topco, have everything tied into that, and just keep it simple. You don't need to be looking at separating out IP and having a holding co in Jersey. It's just going to make it a lot more difficult to close those early rounds. And as you add on layers of investment through Series A and B, as participation rights come into play and preference rights, you really want to just keep it as simple as possible for as long as you can, because it gives you flexibility on those later rounds.
Fantastic, thanks for the insights, everyone. I'm just going to ask Deepak's question that's on the chat. He says, from an investability point of view, what is the panel's opinion on the scalability of a hardware-based product versus a SaaS business? Does anybody want to take that?
I guess I could maybe comment. I guess there are a lot of investors that only look at software. We certainly are one of the few that that do look at hardware. I think there's no less scalability to hardware models. They're just a lot more expensive. So you can sort of build and deploy software and different versions of the software much more easily than you can build physical kit and send it out. And that's why some investors are more nervous just about that sort of capital requirement. But it's about sort of picking the right investors that are sort of keen to work in those sectors.
Excellent. Does anybody else want to add to that? No? Okay. Final question. What are your final tips for any startup or scale-up looking to raise money in their first round or their follow-on rounds that we haven't already covered?
I'd say one on just pitch decks in general. I think because the amount of conversations you have to have with investors, you need one yes, but you can end up talking to probably hundreds of maybe 1,000 different investors, right? And you'd always get advice on what the right pitch looks like, because everyone's slightly subjective, has their own preferences. So I think, yes, lean into your, warm investors, get their steer on it, advisors like you were with me, Kosta, right? Keep some people close and take their opinion, but then get to a point that you're comfortable and confident with your pitch. Otherwise, you'll spend forever and eternity updating that pitch, changing it, etc. So I think know how to tell your story, be confident in what you've done, and then get to a point that, you take that forwards rather than, constantly changing all the time. Because, as I said, you'll spend so long doing that. But you need to take some advice. So it is a fine balance. But, you helped me with that a lot, Kosta, and that, I think having that close network to do that is important. And then afterwards, be confident in what you've got.
Absolutely, I appreciate that. Joe?
Yeah, maybe to build on something somebody mentioned earlier about trust and about openness, and that really goes both ways. So having an equity investment is a potentially really long-term, human relationship. You're working with people at the end of the day. You need to be open with each other, transparent, and you need to just know that you can actually get on and work well with those people. So that just be conscious about the individuals you'll be working with as you go out talking to investors.
Great. Chris, Eleanor, or Max? Any final tips?
Sorry about that. I was on mute for a second. I think trying to get a lead investor on board as early as possible is important. I used to work in the kind of angel space, and angels like to have a kind of credible lead investor. I think VCs also like to co-invest alongside each other, or certainly some do. So, target people very specifically. Do your research on your investor when you're targeting them. Try and get a warm introduction. I know that different people have different views on kind of intros and whether that's kind of not the right thing to do. But actually, I think this day and age, with LinkedIn and people's networks, you can get introductions to people if you want, if you try hard enough. I think it does have value. Yeah, try to lead on as soon as possible.
Eleanor and Max, to close things off.
Yeah, I think I'd just say, obviously we've discussed a lot today and there's so much to think about with fundraising, but also don't just do fundraising. So make sure you're still focusing on developing your business. Obviously, it's easier said than done, but don't get carried away and just focus on the fundraising. You've also got a business to run at the same time and grow.
Just to build on Eleanor's point, I think that's really important. And at the same time, if you are focusing and building the business, investment conversations take place over months. If you can keep it about traction and sort of demonstrate, that you're growing and you're hitting your targets, it makes the investment a lot more appealing. And just to quickly build on Adam's point, he mentioned earlier about being able to communicate what you do very simply, particularly from a crowdfunding perspective. We placed 106,000 individual investments last year. It's so important to be able to tell the story of what you're doing very succinctly, almost like you could explain it to a child. So I think having that really well refined to be able to communicate what you're doing to investors is really important.
Thanks for everybody's insights. We're now going to head back to the main stage for pitches and then followed by the expo and the networking. I've got to head off because I've got to see you all there. So thanks very much, and I'll see you soon.
Thanks, Kosta.